Good morning. Today's session is designed to give you an update on the private credit landscape, highlight a unique investment opportunity, and introduce the Muzinich BDC Income Fund Active ETF. Hi, I'm Marty Switzer, CEO and Managing Director of Associate Global Partners Limited. Thanks for joining us. Now, before we start, the obligatory disclaimer: this is not advice. It's general of nature. It's for educational purposes and does not constitute a recommendation. I'm pleased to be joined today by G He, Portfolio Manager of ASX BDCI, and G is from Muzinich Co. We recently launched ASX BDCI ASX. It's Australia's first daily liquid, actively managed private credit fund, and since 2014, it has delivered an annualized income of 9.8%, and that's paid on a monthly basis. It provides exposure to over 3,600 US middle market loans and is backed by Muzinich Co.'s 30-plus year track record. With the current market dislocation creating opportunities to acquire these assets at attractive valuations, this is a compelling time to explore the strategy. G, thanks for joining us today.
It's my pleasure.
So, G, for those that aren't familiar with Muzinich Co., can you provide some background on the firm and also talk to us about your core focus as an investment manager?
Of course. Muzinich Co. was founded back in 1988. We currently manage about $43 billion US dollars of assets, all in global credit. So we see us as a global credit boutique, where our investment strategies span across from investment grade, high yield, bank syndicate loans, private credit, CLOs. So a number of different strategies and different focuses, but all centered around credit. We have geographic footprints globally as well. The headquarters is in New York. That's where I sit. We also have offices in London and many other places in Europe, as well as Australia and APAC region. So it's a global firm with a credit focus.
Excellent.
I joined Muzinich 9 years ago to focus on this BDC income strategy, where we invest in publicly traded business development companies.
Yeah.
So this is a niche area within private credit. We are buying listed private credit funds.
Yeah. Now, we're very keen to talk about this strategy, which is one of the key reasons for us being here today. But before we do that, G, just to sort of set the scene a little bit, you're an expert in US and global private credit. Can you talk us through the current backdrop that we're experiencing at the moment?
Of course. Just to take the horizon a little bit longer, I think US and global private credit has gone through over 2 decades of rapid expansion. So currently, the whole market sits at $2 trillion globally. That's the global private credit. In US only, that's about $1.5 trillion. So the market size of private credit is very similar to US high yield and US debt market. So it's a very key segment of leverage lending in US, particularly corporate lending to US middle market companies.
Yeah.
There has been several negative headlines around US private credit in recent months. I think there are a few topics that I want to go through today. The first one is concerns regarding software. As every one of us have been living through this AI disruption that's rapidly changing our lives, there have been concerns that because software is one of the key sectors in private credit financing, there can be higher exposure to that sector. And what if some of the software companies are not adapting to this AI disruption and they're having refinancing risks in the relatively near or medium term? So currently, our funds look through exposure to software is about 19%. And even if we are assuming a very dire scenario where, say, there are very high defaults in software sector, say 20%, and zero recovery rate, and that's very conservative, given many of these loans are senior secured. Even with that kind of math, you are looking at 20% exposure, and we're looking at 20% default. So that's 4% of loss of your portfolio value. And currently the index is trading at 85 cents on the dollar. So there have been a very much negative sentiment that's driven by a lot of retail investors in the space driving in the discount valuation to the space that I think are actually quite attractive to institutional investors like us. Yep. Another part of the equation has been a lot of headlines around redemption rates in private credit. And these redemptions are geared towards non-traded BDCs, so not the part of the BDCs that I invest with. I want to give a distinct differentiation on what is seeing a lot of redemption versus the BDCs we are invested in. Yep. Non-traded BDCs are semi-liquid business development companies underlying middle market loans, and they offer 5% quarterly redemption. And currently, these type of funds are seeing redemption requests higher than 5%. Therefore, a lot of them are trying to whether sell assets to meet investor requests, or they are gating investor redemption at 5% as they are allowed to. And these type of vehicles will generally be susceptible to redemption liquidity risk because of their semi-liquid feature. We are actually only invested in publicly traded BDC. Public meaning they are listed on stock exchanges, New York Stock Exchange and NASDAQ. These BDCs are closed-end funds. Because they are listed on stock exchange already, what we are buying into is the equity of these stocks. And because of that, these BDCs are not facing and they don't have the redemption feature. If I don't like my BDC stock, I have to sell to someone else on the stock exchange. So on the BDC level, they are never a forced seller because of redemption or liquidity risk. Yep. They don't have to sell their assets when the sentiment towards the industry is very negative. So that's a key differentiation I want to make on today's call.
Yeah.
And I think the public BDC has been around for over 20 years.
Yeah.
Ares Capital Corporation, for example,
Jay,
has been went public in 2004.
Yeah.
So this type of vehicle has gone through market sentiment changes over time.
Yeah.
And I think this is the best asset liability match for the underlying middle market loan asset.
And I think that's a good segue to start to talk a bit about the ETF that we've launched in association with Muzinich, and to sort of give the audience some background on the Muzinich BDC income strategy that we are now deploying through this ETF. And you started talking a bit about BDCs, and I want to go into what a BDC is in more detail, which really is similar to a real estate investment trust. But before we get into BDCs and what they are, and I guess some of the advantages of them and the types of BDCs we've got in the portfolio, just talk us through the strategy that you're running. It's been going since 2014. It's got a yield of 9.8%. Talk the investors on the call today through the strategy and how it works and what you're actually investing in. And then let's go into a bit of a deep dive on the actual BDC structure itself.
Of course. So the strategy invests in publicly traded BDCs, and these business development companies, each of them extend a portfolio of middle market loans to middle market companies. So middle market company in US is a very broad definition. So you can look at any private company or generally with an EBITDA of $10 million to say $300 million. So it's a very broad definition. It's about a third of US economy, and there are many businesses in this segment. The strategy focused on selecting higher quality publicly traded BDCs. There are currently 49 of them, and currently our portfolio hosts around 20 to 25 of these BDCs. The idea is always to have the high quality bias, because end of the day, even if we're buying the stocks of these companies, we think of ourselves as credit investors. And I think that's a key differentiation of Muzinich versus many other investors in the space, is that we think about our underlying credit exposure through these BDCs. And we want to construct a portfolio of very diversified middle market loan portfolio.
Yeah.
Because in credit, diversification is the only free lunch, and that's very important for the outcome of long-term performance.
So there's a portfolio of 20 BDCs. They're all listed on the exchanges, whether that's the New York Stock Exchange or the NASDAQ. There's similarities to a real estate investment trust, where in a REIT, the underlying assets are property. In a BDC, the underlying assets are loans. Can you give us some examples of who some of these BDCs are? Because they're some of the biggest names in private credit in the world, aren't they?
Yes. So one of the examples is Ares Capital Corporation. So they were one of the early industry leaders. They went IPO in 2004, and currently it's the biggest publicly traded BDC with a market capitalization of over $12 billion. This company extends to middle market loans for over 500 companies. So it has a long running history of extending middle market loans, but also a very broad diversification. So, Marty, to a point, how I think about the portfolio construction is always finding managers having very broad, diversified portfolios with good credit outcome. So through this 23 BDC portfolio, we actually have underlying credit exposure to over 3,600 middle market loans. So that's very important, particularly when you are comparing us to a single private credit fund. A key differentiation is that we don't have manager concentration risk, we don't have sector concentration risk, and most importantly, we don't have issuer concentration risk.
And so in terms of the BDC structure, which is unique to the US, it's not available in Australia. Can you talk about, I guess, the framework of the BDC and some of the transparency and governance requirements that are associated with the vehicle, which is a positive for investors? Keen to understand that structure a bit more and how it works.
Of course. So to your early point, business development company is a U.S. only structure. It was approved by U.S. Congress back in the 1980s, though it gained a popularity post 2008 financial crisis, as many private credit lenders is using this structure to have their private credit funds go public through the stock exchanges. A business development company, just like a REIT, they are considered regulated investment companies. So these are corporate forms, and they are pass-through entities in terms of income. So for a real estate investment company, you have to pass through 90% income generated from the real estate properties, and you are tax exempt on the corporate level. Very similarly, BDCs have to pass through 90%, distribute 90% of their income generated from middle market loans on an annual basis, and to be exempt for tax exempt purposes on a corporate level. And these entities are regulated both by Security Exchange Commission in US as well as FINRA. And because these companies are public companies, so they are under the scrutiny of media as well as sell-side Wall Street research analysts and buy-side analysts like me. So they have a lot of attention and a lot of disclosure requirements. One I find extremely helpful is just like any public company, they have to publish quarterly earnings, not just the company financials in terms of balance sheets or income statements, but they actually have to disclose a schedule of investments detailing each underlying middle market company loans, what the company they're lending to, what the sectors they're lending to, what's the coupon rate, is the coupon rate current, is the coupon rate cash, and what's the current valuation. So a lot of our analysis goes through the valuation of these loans because these are private companies and these loans are generally not traded in the public markets. And we try to compare the valuation across different BDCs because oftentimes they partner up on deals. And also through quarter to quarter, we see the migration of valuation to see if there are any cracks in the credit performance of the portfolios.
And from what I understand, G, for some of the BDCs, probably the better ones, and some of the names that we've sort of touched on, you mentioned Ares, but there's like Blackstone, Apollo, BlackRock, a number of the very well-known alternative managers. From what I understand, a lot of these groups work particularly close with the underlying companies that they lend to as well. Could you sort of elaborate on that point some more?
Of course. So a lot of the BDCs we invest with are global alternative asset managers. So they have the private equity arm and they have the private credit arm. Generally speaking, they cannot lend to the companies they invest with through the private equity side. So generally speaking, a BDC cannot, a Blackstone BDC, for example, cannot partner in a deal where Blackstone is the majority equity holder in that transaction. So I think that is another very important compliance or governance type of control that we have because we have the visibility of the entire portfolio. However, because they are Blackstone, they can work with many other alternative asset management houses, and being Blackstone helps them source the deal, for example. So, from that perspective, I think you still benefit from being in large alternative houses. My strategy up, I think the core portfolio is these high quality global institutional large alternative houses, but we also have allocation to smaller and nichier BECs where they might have an industry niche and focus on a smaller segment. Main Street Capital, for example, is a BDC focusing on lower middle market. They are headquartered in Texas and they have done very well in terms of having equity realizations because generally when we're lending to smaller companies, you have more participation on the equity side where you may get equity warrants or equity co-investment opportunities. And over time, that can help you actually grow your net asset value as a lender.
Yeah, no, excellent. Thank you. So we've talked about this vehicle that you're running using the Muzinich strategy, the ETF that we're now distributing, and effectively, just to make it clear, this is an open-ended fund that trades at the net asset value of the fund less the fee. So it's not a closed-ended fund, not like a LIC or an LIT. It's an ETF. The underlying investments, G, are BDCs that are closed-ended vehicles, and we've sort of touched on this, but I'd like you to elaborate some more. These BDCs can trade at a premium to the NAV. These BDCs can trade at a discount to NAV, or they can trade at NAV. Talk us through this dynamic and sort of how that plays into your portfolio construction process.
Of course. I'll start with, you kind of have two questions there. So I'll start with the first one.
Thank you.
I think it's very important to note that this strategy is an open-ended strategy and it offers daily liquidity. That's kind of one of the uniqueness of the strategy. I think even investors Illustrated probably had exposure to many US private credit products. This is one of the rare ones because these EDCs are publicly traded on stock exchange. This is where you can actually get real liquidity on a daily basis to have access. So this is one a distinction I want to make. The NAV of the fund is made on a daily basis, and our fund will always trade at NAV. The NAV is a very clear, easy calculation based on the stock price changes on a daily basis times the percentage of weights in each stock. So this is very clear. We're not making any assumptions on the NAV of the fund. And the second part to your question is on how these BDCs trade on an individual basis. So each BDC are traded at price to net asset value, and that fluctuate over time. So historically, on the past 10-year basis, the industry trades around 95 cents on the dollar on average. There are times when the industry trades at a premium. That's generally because investors are very enthusiastic about getting the income in private credit, whether it's higher interest environment or low default. Um, or generally, people are thinking the returns of these vehicles are increasing because they are getting higher yield from the underlying loans and they are going to increase dividend. So it's kind of that expectation shapes the everyday changing daily valuation of the BDCs. So each BDC can trade at discount or premium, and that changes over time. However, on a longer term basis, generally, if you are a BDC that has relatively benign credit performance, meaning you have relatively low default rates and you are delivering your 10% annualized dividend yield, that type of BDC generally trade at premium, close to net asset value, or at premium from time to time. And if you are a BDC with a lot of credit issues, you have a higher ratio of non-performing book in your portfolio. And that type of BDCs will trade at discount, deep discount, even when the market is trading at premium. So that there is a very large dispersion on each individual BDC basis. And currently, because of the sentiments are quite negative, particularly in retail investors' eyes towards US private credit, the industry is trading at around 85 cents on the dollar at the market close today. So still a 15% discount. And that's one of the higher discounts I've seen over the past 9 years.
Oh, yeah.
I think the last time we traded around this level was in 2022 when the base interest rate went from 0% to 5%, or when people were fearing for higher defaults because of the higher interest rate.
And it's based on that sentiment, G, that I think we believe why this is a compelling opportunity now for this type of vehicle. If you said the historical average is 95 cents in the dollar, we're currently at 85 cents in the dollar. Is that the opportunity that we're talking about, or is the opportunity also getting back to NAV?
I think generally speaking, it rarely trades exactly at NAV because of the daily sentiment changes.
Sure.
But the idea is that generally BDCs need a couple of quarters of earning. I think the current concern are centered around higher defaults and credit losses coming in a big way. Software is one of the larger sector, but my math tells me that even this 20% exposure in software is having a 20% default rate with zero recovery. That's about 4% of my portfolio value wiped out. And even that type of math, 95 cents on the dollar sounds like a real fair value. I think the reality is that for the valuation for these BDCs to recover, I think it takes a few quarters of earnings for them to prove that we're not seeing the widespread credit defaults. My expectation is that I think the software default rate will increase because of the binary nature. The recovery rate will be lower as well. So private credit in US historically is 1% default rate over 20 years.
Yes.
And the recovery rate was around 60 cents on the dollar to 70 cents on the dollar.
Yeah.
So my expectation saying that software is going through 20% defaults and zero recovery is very conservative in my view.
Yeah.
And even with that kind of very bear case scenario, you are looking at 95 cents on the dollar. And that's why I think the market is very compelling at the moment. But it will take a few quarters of earnings for investors to prove, because if you are investing in middle market loans, and unless that loan is facing refinancing risk, or the company is underperforming to large degree, you can't see that valuation change right away. And that's a challenge as any investor. So as an active investor, we're trying to be ahead of the curve, thinking about what are the subsectors within software that can be impacted by AI more broadly. And we're trying to make our evaluation of the BDC software work.
What's just to remind the audience what the current default rate is now, and then what it was, say, during the GFC, and effectively what you're saying is it would, would get to like a complete, really bearish situation where it was 20%, and if it got to that, which is quite extreme, the total impact's only going to be 4% to the returns of the portfolio. Can you just flesh that out a little bit?
Of course. So, like I mentioned, this is Cliffwater research as well. So, they track over 10,000 middle market loans. So, they are very broadly tracking the middle market private credit sector for over 20 years. So, 20-year average default rate is 1%
Yep.
annually per annum.
Yep.
The stress scenarios in the past, global financial crisis, is 9%
Yep.
default rate.
Yep.
2020 COVID, even though very short-lived, but that was quite a shock. At the high point of default rate was slightly over 4%. So that's just giving you some context of what's happening and what could happen.
Yep.
The recovery rate historically on average is 60 cents to 70%. So even when a loan goes to default, doesn't mean you are having the credit losses.
Yeah.
And that's why it's very important to be in a public BDC vehicle or some sort of permanent capital vehicle where the private credit manager can actually have the flexibility to keep the investments, not selling at the worst time, and try to restructure the loan and work out the deal and get you the recovery. This is another part of my evaluation of the BDC managers for longer term. It's not just what company you invest with. As a credit manager, inevitably you will see defaults, you will see credit issues. It's what you do with these companies afterwards and what's the outcome on average basis for longer period of time that matters. So that's why I think the 20% default rate and zero recovery is quite a bear case scenario.
Yeah, no, we'll explain. Thanks, G. Now, we've talked a lot about software, but can you give some examples of some of the other sorts of loans or the types of companies that the BDCs, like your Apollos, Blackstones, BlackRocks, Main Street, you mentioned before, are lending to? Some, I guess, tangible examples for investors to understand.
Of course. So, like I mentioned, they lend to very broadly in U.S. middle market.
Yeah.
In U.S. middle market, they have over 200,000 individual companies, and altogether they are about a third of U.S. economy. So if you take out U.S. middle market on its own, it will be world's third largest country. So it's a very large ecosystem of company they're lending to, and because of the diversified sector exposure nature of U.S. economy, the BDCs lend to very they're broadly diversified sector. So software is the top sector. My current look-through exposure is 19%. Software is also a top sector for U.S. economy. So even if you're looking at your S&P 500 companies, and that's even more than 19%. And the second largest in BDC lending to is business services. So this is also a very broad. U.S. services are 80% of U.S. economy. So that's a very large part of U.S. economy. It's also very broad. So to be clarified as a business services, you can be performing government contracts, government consultants. You can be servicing to your local grocery stores. You can have very wide range of sector exposure. And the third largest exposure is healthcare. So that's also a very big part of where private equity sponsors like to lend to, because generally healthcare, for example, is one of the sectors you are less susceptible to economic cycle. So generally you have more stickiness of the revenue. And even when we are looking at the software sector, if you are a software company providing your software services to a healthcare company or any type of regulated entities, I think you actually will have a better outcome with this AI disruption because of that regulated nature and stickiness of the capital.
And then I guess across the portfolio, could you give, I guess a band of the types of loan sizes that the BDCs make, like the smallest to the largest? And I guess maybe is there like a typical size that investors could just, I guess, get an understanding of, what these loans actually look like in dollar terms?
Of course, I would say the smallest loans are lending to companies around $10 million of EBITDA. And generally, these loans are 3 times levered. So you're looking at a 30 million loan.
Yep.
And generally to lower market companies. And you may have 1 million of equity co-investments with this company. And the largest you can be lending to a company with $2 billion of revenue and $200 million of EBITDA. And generally, these companies are 5 to 6 times levered, probably closer to 6 times when you are at that type of scale. So that tranche can be $1.2 billion, but each BDC is taking only a slice of that investment. So that's very important because even with such larger transactions, you want to keep your portfolio exposure to 1 to 2% tops.
Mm. So liquidity, G, just sort of keen to talk through that. And that was, I guess, a big attraction for AGP in partnering with Muzinich on this strategy. The private credit landscape in Australia, both sort of, domestic and, global managers playing in this space is crowded. And there's a lot of, let's call it, wholesale funds out there where, you can get some high returns, but there is a lockup. This particular strategy is daily liquid and there are no lockups. Just talk us through why and how.
So the daily liquidity is definitely one of the key features of the strategy because we're only buying publicly traded business development companies, so we're buying the stock on stock exchanges. So this is the only way through all the private credit funds that different alternative investment houses offer. This is the only way to get daily liquidity in a very consistent way without any issue. I think the most newest invention of private credit vehicle is the non-traded BDC, and we're definitely seeing that type of vehicle going through some challenges within the redemption risk and liquidity risk. However, public BDC doesn't have liquidity risk, and it's being very reliant in providing liquidity to investors. And another part I want to mention, not just on the liquidity side, but also is that because of this type of buying the stock, it actually creates a form where it doesn't have much of a minimum investment requirements because we're just buying the stock. So in many ways, this is a very modern way to buy into a diversified private credit assets that's rarely funded anywhere else. So the caveat is the volatility because these are publicly traded. You cannot get away with the volatility of the stocks, just like for S&P 500 exposure or any type of exposure. So I want to be very clear on that one as well. I think currently volatility can be our friend if you enter at very attractive valuation. There can be times where volatility takes you to a premium valuation. So we're seeing some opportunistic investors in the space as well.
Yeah.
Because this is a rare way of you can buy private credit at discount.
And I think on that point, G, of volatility that you may or may not experience, but it is possible, that ultimately is the price of liquidity. The fact that you can get these sorts of returns that have been generated, since 2014, close to 10%. The fact that you can get that in a fully liquid structure means that the capital may move up and down, but when you look at it, or when you look at allocating capital to a sort of strategy, you've still got to take a long-term investment horizon. It's just if you need your capital, it is accessible.
Yes, definitely. And we've run the strategy generally with a very long-term mindset. We see ourselves as fundamental credit investors, as if we're holding the middle market loan. So we do a lot of analysis on the underlying middle market loan exposure. We do a lot of meetings with BDC management. We've met with all of them over the past 10 years. We've always run the strategy thinking about the longer term investor, focused. And I think over time, we've done a better and better job in terms of keeping our investors invested through the market down cycles. And that helped with our longer term performance of the strategy as well.
And I think the other point to note is that so there are larger, there can be other large, let's call it closed-ended funds that are listed that have that are quite liquid, but you may sell out in some of those larger closed-ended type funds. You may sell out at a discount. Where this fund has daily liquidity, and if you exit, you will exit at NTA. You won't exit at a discount or a premium. You'll exit at the NTA of the portfolio. Is that correct?
Yes, because the actual mechanics is that when people redeem from our fund, the active ETF, all I need to do is to sell the shares of the BDC stocks pro rata at that market close prices. So there is no discount or premium valuation to be wiggled through. Basically, I'm just selling the stocks of your pro rata share of the portfolio.
The discount you will actually get within the actual portfolio itself based on your actively managed strategy that you run, right? If there is a discount to buy,
Yes.
And then just sort of, I guess, one last question, and then just keen for any closing comments that you might have. So the fund offers monthly income, high monthly income. I mentioned before a couple of times that since 2014, it's done 9.8% per annum. What sort of yield are you currently targeting at the moment based on the opportunity in the landscape? You sort of talked about, the 85 cents in the dollar. What are you sort of forecasting at the moment?
So we are actually at 11% yield. So slightly higher than the 9.8% because of the discount valuation. And we are seeing moderate risk of dividend reductions, meaning if the Federal Reserve continue to reduce rates, the BDCs can reduce their dividend accordingly. However, we generally see this as very attractive income when compared to other fixed income asset classes, because when the base rate changes, everything's relative. So we're still looking at a very healthy over 10% of dividend, even pricing in some of the dividend cuts. So we've seen, we went through first round of dividend cuts in the first quarter of 25. There might be few more to come, but generally when they are cutting their dividends, it's in the range of 10 to 15%, basically realign with the current base rates level. And because of the floating, I think with the current private credit headlines and the negative sentiment, it's the first year in a few years we're seeing the first time the credit spread is actually increasing in new transactions. So that actually helps stabilize the dividend yield over time. So I still think 10 to 11% is a very tangible dividend yield to achieve.
Thank you. G, before we go and wrap up, any closing comments for you that you'd like to make?
So definitely very, very happy to meet with Australian investors and very pleased to work with AGP in launching BDCI this at the beginning of this month. I'm very excited by this new adventure and very look forward to work with or meet with many of you.
Thanks for your time today, G. And thank you to everyone who joined the webinar. If you'd like to invest, you can do so via the ETF on the ASX or through your broker. The code is BDCI, or via the actively managed fund, which you can access via our website, associateglobal.com, or talk to your financial advisor or broker. Thanks for your time today. Talk to you later.